Somebody shorted oil by hundreds of millions of dollars about 20 minutes before Trump announced that everything was going to be okay. If you saw that once, you could dismiss it. When you see the same pattern again and again while the Strait of Hormuz keeps moving back and forth between open in the headlines and closed in the shipping data, dismissal stops being analysis. It becomes denial. That is where I want to start, because the real story is not just that oil is going up. The real story is that the paper market is still trying to calm the public while the physical oil market is already in emergency conditions. And if history tells us anything, it is that the paper market can manage sentiment for a while, but it cannot win against the physical world forever. That is the whole problem. For days now, people have been fed a very convenient story. The strait is open enough, the worst is behind us, the market has stabilized, America is a net exporter anyway. Everything is under control. That story works only if you never leave the screen. The moment you look at the actual shipping flow, the actual cargo timing, the actual delivery shortages, and the actual physical price of oil, the story starts falling apart. That is because there are now two oil prices. There is the paper price and there is the real one. The paper price is Brent futures, the number everyone sees on Google and business television. The real price is what buyers are actually paying to secure physical barrels that have to be loaded onto real ships and delivered to real refineries. That physical benchmark. Dated Brent is running dramatically above the screen price. The spread is not normal. It is not a few dollars. It is over $30. And by the standards of modern commodity trading, it is historic. That spread tells you the market is split in two. The financial story still says calm down. The physical story says pay whatever it takes. The people who genuinely need oil right now are no longer trading narratives. They are bidding for survival. That is what creates a gap like this. In normal times, the paper and physical prices move together closely. They do not live in separate universes. When they suddenly do, it means the system is under strain severe enough that the screen is no longer telling you what the world is paying. That is why I think the most important line in this entire story is very simple. You cannot print physical atoms. The paper market can sell promises, it cannot create barrels, and once the real barrels get scarce enough, the promises have to reprice. Everything else flows from that. Start with the basic U.S. energy myth because it matters politically. Americans keep being told that the country is a net exporter and therefore somehow insulated from a global oil shock. But the actual math is more awkward. The U.S. still imports more crude than it exports. Roughly 6.3 million barrels a day come in and about 4.1 million go out. That means the United States remains a net importer, around 2.2 million barrels a day. So no, America is not magically standing outside the crisis. It is simply farther back in the physical line. And being farther back in line is not safety, it is lag. That lag is exactly why the U.S. public still feels relatively calm while other parts of the world are already getting hit hard. Asia was first, deliveries collapsed there early. Asia sources the overwhelming bulk of its oil from the Persian Gulf. So when that flow breaks, the pain shows up immediately. The Philippines moved into emergency footing after fuel prices exploded. Indonesia and Vietnam began trying to suppress demand. Thailand's fishing industry started shutting down because marine fuel became unaffordable. Japan slowed bus and ferry services. India restricted commercial LPG to protect household use. These are not theoretical models. These are real economies already adjusting to less fuel. Then Africa starts feeling it, then Europe, then Australia. And finally, the United States, which does not escape the shock, only receives it later. That later point is right now. The last tankers that got out before the closure are approaching the end of the pipeline. Once those pre-closure barrels are fully worked through the system, the buffer is gone. That is why JP Morgan's timing matters so much. The institution is essentially saying that around now, the world stops living off the old flow and starts confronting the new reality. And the new reality is ugly. The world consumes about 100 million barrels a day. The disruption we are dealing with is somewhere in the range of 8 to 13 million barrels a day. That is a massive hole, even if you add up emergency stock releases and every short-term workaround. The total alternative relief still falls far short. At best, you get about 2.8 million barrels a day from reserves and emergency measures against a hole that is several times larger. That means the emergency tools do not solve the crisis. They only delay the point at which the shortage becomes visible. This is why I think the interstellar analogy in the original document is so good. Everyone is staring at the horizon, thinking the market is seeing mountains. Those are not mountains, that is the wave. And now it is close enough that the paper market is starting to look less like price discovery and more like narrative management. That is where the shorting pattern matters, if massive paper shorts keep showing up right before official reassurance. then the function of the paper market is not just to price future oil. It is to suppress psychology in the present. It is to tell investors, consumers, and politicians that the crisis is already easing, even while the physical chain says the opposite. But that game has a limit. A futures contract is still a promise to deliver something. If the seller cannot eventually produce the oil, then what looked like calm becomes a trap the moment the buyer asks for the barrel. The seller has to go into the market and buy it back at whatever the real price has become. That is the mechanism for a short squeeze. And in an oil crisis, a short squeeze is not just another trading event. It is the instant when physical reality overruns financial theater. History says this can happen much faster than people expect. Look at 1973. Markets stayed strangely calm for a while after the embargo. People wanted to believe the worst was over. Then they discovered that supply losses do not care how badly financial markets want to normalize. Stocks ended up collapsing far more deeply than inflation, so recovery took years. Look at 1990, smaller supply loss, faster war, faster recovery, still a recession and still a major correction. Now compare those episodes to today where the effective disruption is potentially much larger and the market is still sitting near highs as if none of the old rules apply. That is not confidence. It is a refusal to translate physical scarcity into financial consequences, and that refusal shows up everywhere. Wall Street is optimistic, consumer sentiment is miserable. Bond yields in the US, UK, Germany, and Japan are rising. China, S yields are falling, fertilizer prices are climbing toward levels that historically feed straight into food inflation. Months later, every one of those signals is telling you the same thing. The shock is real, it is spreading, it is not fully priced, and once it is fully priced, it will not show up only at the gas station. It will show up in rates, deficits, equities, and food. That bond market piece may be the most important of all. The US 10 year yield is the base price for huge parts of the American economy. Mortgages, car loans, corporate financing, credit, government debt service. Once yields rise high enough, the issue is no longer, is the economy slowing? The issue becomes, can the debt system absorb this level of funding costs without breaking something important? That is where the debt spiral logic starts coming in. If oil pushes inflation up, the Fed cannot cut. If the Fed cannot cut, yields stay high. If yields stay high, the deficit worsens. If the deficit worsens, treasury supply and funding fear rise, and then the bond market becomes a bigger problem than oil itself. This is why the war matters far beyond the strait. It is not just about energy, it is about whether the United States can maintain the whole fiction that the screen price is reality, the bond market is stable, the stock market is correct, and the physical world will obediently line up behind all of that. The original theory in Washington seems to have been straightforward. Disrupt Gulf energy, squeeze China and Russia harder than you squeeze yourself, reassert American control over the energy map, and emerge stronger. But what actually happened looks much messier. America burned through key missile inventories quickly. Replenishment depends on supply chains. China influences oil shocks, pushed inflation pressure back up. Bond yields rose in the West. China looked more stable by comparison. Fertilizer moved higher, setting up future food pressure. And the rest of the world got a fresh reminder that the physical world always gets the last word. That is the central conclusion. The screen can lie, the tanker cannot, the White House can celebrate, the shipping map cannot, the paper market can postpone recognition, it cannot abolish scarcity. And that is why I think the oil shock has not really hit America yet. The US has been protected by transit time, not by structural immunity. Once the last pre-closure barrels have been consumed, the delay is over, then the gas station feels it, then food starts to feel it months later. Then equities are forced to explain why they treated a supply emergency like a mood swing. Then the bond market has to decide whether this is just inflation noise or something more sinister. Could peace still arrive in time to soften all of this? Yes. Could the strait reopen faster than expected? Yes. Could refineries, routes, and inventories recover more smoothly than the worst models suggest? Yes, those possibilities exist. But if you look at the physical data rather than the official story, the same conclusion keeps showing up. Shipping disruptions, reserve math, regional shortages, fertilizer, consumer sentiment, and bond stress are all pointing in one direction. Paper saying relax, physical saying prepare, and in every meaningful commodity crisis, physical reality eventually wins that argument. Not because it is louder, because it has the barrel. That is where this is going. At some point very soon, the market will stop asking what oil looks like on a screen and start asking what it costs to get a real barrel delivered today. That is the moment when the managing stops. That is the moment when the wave reaches shore. And if that happens the way the physical market says it should, then America is about to discover that being the last to feel the shock is not the same thing as being protected from it.